Hi, I'm Kathy Schaefer for Parents Corner on AACPS TV. Stay tuned for our show on college savings and teaching your students good financial habits. I'm Kathy Schaefer, and this is Parents Corner on AACPS TV. Each month we talk about a topic of interest to parents like you and me. This month it's college savings and teaching students good financial habits. In its most recent survey, the College Board reports average annual expenses ranging from more than $3,000 at a public two-year college to more than $31,000 at a private four-year college, and that's per year. Savings can be a daunting prospect, but don't fear, it's never too early or too late to start. We spoke with Lauren Shipley, the Executive Director of the College Savings Plans of Maryland, for advice on available options. Can you tell us exactly what is a 529 plan?
Sure. It's actually the IRS tax code that allows people to save for college in a tax-deferred way. So a lot of times people think of 401k for the retirement plan at work. 529 is the same thing. It's the tax code that allows people to save for college.
Okay. And I know that Maryland has two 529 plans. Can you tell us what those are and maybe what the difference is between the two?
Yeah, absolutely. So there are two plans. A lot of people don't realize that both of the 529 plans are in fact 529 plans. We have the prepaid college trust, which allows people to lock in tuition at today's prices for future benefit. The idea is to hope to hedge against future tuition increases. And then the college investment plan, we work with T. Rowe Price to manage about 15 or 16 different investment options, more like a savings, sort of a retirement plan where you choose the investment option and then the money grows according to the investment choice.
Okay. And who is eligible to enroll, and is there an enrollment deadline?
Sure. So for the prepaid college trust, we do have a specific age group. So you have to be a 12th grader or younger in order to participate. For the college investment plan, though, it's actually for all ages. So it could be children, it could be adults. Maybe they need to go back to school to get some retraining or to just change their career path. Adults can actually use the accounts to save for themselves. With the prepaid college trust, there is a specific enrollment period where people enroll within a certain period of time. It started on December 1st and now is running through April 20th of 2016. So anyone who hasn't enrolled in the plan, that's when they can enroll. But good thing to note is they don't have to make their first payment until August 1st. So a lot of times people have analysis paralysis making that decision before the deadline, but luckily they don't have to make a payment until August 1st. And then the college investment plan, though, is all year long. So if that decision becomes too difficult or just the savings plan is a better option, you have any point in time during the year to participate there.
And is it ever too early or too late to start one of these plans?
Absolutely not. Obviously there's benefits if you start earlier, especially with the prepaid. The payments can be more affordable because you're spreading them out over time. But it's never too late. Any dollar that you save can really help reduce that need for student loan debt in the future. We even did a study with T. Rowe Price, our partner, about the difference between saving versus borrowing. And this example that we used, it came that college costs actually get cut in half when you try to save versus borrow. And we used a $25,000 example, but you could do it, for 5 or 3, and we have that example on our website to really help to see the difference of what that saving can make a difference in.
Okay. And when you do one of these plans, can you only use the money at a Maryland school?
No, you can use it in or out of state. A lot of times people hear Maryland in the name and assume, well, it's only good within Maryland, and that's not the case. It can be used at federally accredited schools across the country. With the prepaid plan, it can be used in-county or in-state as well as out-of-state and private schools. The college investment plan, same story, but also can be used for trade and technical schools that have a federal school code. A lot of them now want to offer federal financial aid, so they're going through that process of getting an accreditation from the Department of Education, and then that allows them to offer federal financial aid, get that school code. So even some trade and technical schools are eligible in or out of state in the college investment plan.
Okay. And as you're putting money away, once your children reach that age, can you only use the money on tuition, or can it be used on other supplies like books or technology?
Yeah, absolutely. So the prepaid college trust actually is initially for tuition and mandatory fees. However, if the student gets a scholarship, grant, or tuition remission, it can be used towards other eligible college expenses such as room and board, books. Even recently, laptop computers became an eligible expense. The college investment plan, a lot easier. It can be used for any of those expenses. So it can be used for room and board, tuition, and both of them can be used in tandem, even if the student winds up getting a scholarship or has some grants.
Okay. And I know we all have best intentions, but what happens if your child decides not to go to college at all and you've been saving up all of these years? What happens to that money?
Absolutely, yeah. So it can be refundable. These are voluntary savings plans, so we certainly want to work with people in regards to that. The thing is that the IRS is involved. These are tax-deferred plans. So you would be able to take the money out if the student got a scholarship, grant, tuition remission. Just take the equivalent money out and then only pay income taxes on the earnings. It's after-tax dollars going in, so you're only paying income taxes on that extra money, the earnings. If you take it out because you didn't have educational expenses that were qualified, then you are going to pay that income tax plus a 10% penalty. But that makes sense. If you take it out early from your retirement plan, didn't use it for a qualified expense, same story. But again, it's on the earnings, the extra portion, sort of going back to that idea, if you wind up saving and don't need it and didn't have to take a loan, you're still doing better off than if you have to take out and pay on that extra money.
And what would be the initial investment, and how affordable are the plans? How much do you need to start to even look to starting one?
Sure, absolutely. So the prepaid college trust is based on the age and grade of the child, and it's over time. There's a number of different payment options for the prepaid trust that can make it more affordable. But you can purchase anywhere from 1 semester in the prepaid plan on up to 4 years of university or 1 or 2 years of community college. Also then with the college investment plan, you can do that in any dollar amount. So very often I say when you look at the prepaid, this is where we tell you how much to pay based on the age and grade of the child. With the college investment plan, it's where you tell us how much to pay. Minimum there is $25 a month from your bank account. We can even do payroll deduction for many employers. Or you can do a one-time $250 with the college investment plan. Just put money in for birthdays, holidays, that type of thing. The prepaid's a little harder to explain what the minimums could be, but because of the flexibility and a lot of different payment options and tuition plans, you can find one that fits your budget.
And as you were saying, the amount and taking it out and things like that, is it only parents that can contribute? Or if you had grandparents, relatives, are they able to contribute to the same plan?
Absolutely. It can be a family affair. We have plenty of families who do that. I think it was last year or the year before, we had a family that came in with the grandparents and they sat around the table and said, okay, Mom, you're going to take freshman year, and Dad, you're going to take, sophomore year, and so forth. So we have plenty of grandparents who participate. And the nice piece about that is if they do open up their own account and they're Maryland taxpayers, they can take a benefit of the income deduction. So both of these plans, because they're sponsored by the state of Maryland, allow taxpayers to get up to a $2,500 income deduction on their Maryland income taxes each year. And that's per beneficiary or per account. So the beneficiary can have multiple accounts in their name. So Mom can have an account for their son, Dad can have an account for the son, Grandma and Grandpa can have an account for their grandkids as well and still take advantage of that income deduction. So it certainly can be a family affair.
And that's great because taxes are obviously on everyone's mind right now.
Absolutely, absolutely.
Yeah. How can we find out more about the plans? Is there a website to go to? Or?
Absolutely. So Maryland529.com is our main website. There's all sorts of information there, obviously, but also we have a pre-recorded webinar so people can listen to a longer presentation about the plans. We go into all the detail that we've talked at a smaller level here. Also, too, there's live webinars that we do have a schedule listed on the website. People can join those, and then we actually have a 30-minute Q&A as part of that, which is live, that people can then ask follow-up questions to that webinar. So we also do have a phone number as well, and it's 1-888, not 800, 888-4MD-GRAD, and we have service associates that can help answer questions about either plan.
Okay. And I know obviously you're not an investment consultant, but what would be the benefits of these plans versus just a traditional bank savings account that parents are putting money towards?
Sure, absolutely. So first off, the income deduction. So this, you get the benefit of that within the state of Maryland, but also that tax-deferred growth. And if you consider a savings plan, I'm not sure what the interest rate on them are these days, probably what, 1/4%, but you have to consider inflation in the U.S. is about 2.5% right now. And what about tuition inflation? We've been lucky enough in the state of Maryland that it's been fairly minimal, but on average across the country it's been about 6. So when you consider you're only making, let's say, 1/4% on your money in a savings account, but these costs are going up, you really can see that you're not making a dent in that. So a plan like a 529 that helps you with that tax-deferred growth and does give you some variety of investment options really can help make a difference.
Well, it sounds like a lot of pros. Are there any cons that we should know about?
I'd love to tell you that there was. I mean, saving for college is always an advantage because if you don't need to take that loan, then you really do come out ahead. Even if they don't go to school, you can take the money out. You're not restricted. It's not a use it or lose it type thing. So I'm a big proponent. I was a financial aid counselor when I was in graduate school getting my graduate degree, and saw a lot of situations where people hadn't taken advantage of saving and then were straddled with loans for a long time. So I really struggle to find a negative. Yeah, exactly.
Great. Well, thank you very much.
Yeah, thanks for having me.
To learn more about the plans, visit collegesavingsmd.org. While parents concentrate on savings, students themselves need to learn good financial habits. Steve Ames, the chair of the Financial Education Foundation of Anne Arundel County, talks to us about how.
We provide financial education to underserved populations with the realization that there just isn't a lot of quality financial information out there, and we want to play our small role in doing something about it.
Were there any particular challenges that you were addressing when you started to do your workshops?
Absolutely. The data shows that millions and millions of teenagers are graduating from high school every year, and they simply do not understand the basic concepts of personal finance, and they're simply unprepared to make basic financial decisions, and this is going to have dire financial consequences down the road. And we feel that there's just not enough quality information out there, and we want to do our small part in doing something about that.
So what exactly do you cover in your workshops?
We have a number of different sessions, and one of them deals with money management, and that would include the notion of budgeting and cash flow, savings and spending. We have a number of sessions or modules on borrowing, dealing with debt issues and credit cards. We have a session on earnings power, which really deals with managing a paycheck and deductions and company benefits and what comes out of a paycheck. We have a number of courses on investing, and as you might imagine, that's one of the most popular areas for students. We talk about establishing long-term goals and talk about all the multitude and the variety of the investment vehicles that are out there that would be used to attain these goals. We teach a session on how to become a millionaire. We feel that becoming a millionaire is a very, very, very achievable goal, and with a long-term systematic disciplined savings program for a few $1,000s a year, that accumulating $1 million over a lifetime is really very, very attainable and a realistic goal.
So is there a good age to start teaching your students about good financial habits?
I would say there is no too early, no later than the teens, and by the time that the student hits the high school year, they should have a basic conceptualization and understanding of disposable income.
So are there top 1 or 2 tips that parents should know in teaching their students good financial habits?
Funny you should ask. Yes, the primary one is get in the habit of saving early, and the second one is become a discerning consumer, and what I mean by that in terms of your purchases and expenditures that you make is you need to distinguish between wants and needs. A pair of $150 basketball needs is more likely a want than a need, as is the coolest cell phone out there.
So in your opinion, is there an appropriate age that a student should have their own savings account and or open their own debit or credit card?
There's really no downside to having a savings account. There's no too early as far as I'm concerned. With a savings account, a child or a student learns to understand interest and how to compute it and what it is. And also, you should make sure that you have a savings account with a low initial deposit and no minimum balance. Debit cards are often the best way to go in many instances for the simple reason that you're limited in terms of the amount of funds that are in your account in terms of how much you can withdraw.
Are there online resources that parents can look to find information about scholarships under student loans?
There are quite a large number of fantastic sites to find information both on scholarships and student loans.
To learn more about the Financial Education Foundation and its workshops, visit FIFA.org. I'm Kathy Schaefer, and this was Parents Corner. Email us at parentscornertv@gmail.com with feedback or dates for upcoming events at your school. And like our Facebook page to stay up to date on show topics. Thanks for watching.